Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the gold, silver, and copper markets for Monday, July 25th. Starting off here with an intraday 4-hourly chart of the August gold contract. You can see that by virtue of overnight's break above last week's 1605 to 1610 area resistance, the market has rendered last week's sell-off attempt, mere lateral sell-off attempt, as corrective and consolidative, and the secular bull trend has been reinstated. And it most importantly has defined the recent 1581 spot 10 low from last Wednesday as the latest and absolute tightest risk parameter this market is now required to fail below to confirm at least a bearish divergence in short to intermediate term on a short to intermediate term that might expose a larger degree correction or reversal lower. In lieu of weakness below at least 1581, further and possibly accelerated gains are anticipated. Moving here to a daily log scale chart, you can see the importance of the key long-term importance of former 1555 to 1575 range resistance that thus far, since broken, has acted as new support within the secular bull trend, and a weakness below at least that 1581 low required to even defer the secular bull trend, let alone threaten it. From a longer term perspective, we still believe that a break below the 1541 corrective low from July 12th, which clearly would be a failure to sustain gains above this former resistance new support range between 1555 and 1575, is needed to really threaten this secular bull trend and expose a much larger degree correction or reversal lower. In lieu of such weakness, further and possibly accelerated gains remain anticipated. From a very long-term perspective, and as we've discussed in some of our recent technical blog updates, the market has approached an area between 1620 and 1630 that we believe bears some Fibonacci progression relevance. Here, looking here at a weekly log scale perspective, the 1630 area is that level that would make the suspected third wave rally from the 865 low from April of 2009, 61.8% longer than the initial first wave rally from 681 up to 1007, and also a level that we've discussed a lot recently, the 1620 level. Looking here at a monthly log scale chart at 1620, this suspected major fifth wave rally from that 681 low back in October of 2008 will be 61.8% of the net distance of waves 1 through 3 from that July 1999 low down at 253 up to the 1034 low from March of 08. Oftentimes the suspected fifth wave will be 61.8% of that net distance, and that cuts across at 1620. Combined with that 1630 level mentioned earlier, and the fact that bullish sentiment has regained levels that are historically extreme, indeed at an 84% level in the bullish consensus. That's the highest that sentiment indicator has been since the November 09 period that witnessed a pretty significant, about 20% correction from 1227 down to 1044. We want to be leery of any kind of momentum failure that, combined with this extreme sentiment and these Fibonacci relationships, might expose a larger degree correction or reversal lower. But the resumption, Friday's and overnight's resumption of the secular bull trend, and even the past month's, this month's bull trend, has been very accommodative in defining recent corrective lows and risk parameters at 1581 and 1541 on both a short to intermediate term scale and a longer term scale. In sum, a bullish policy is advised, with weakness below at least 1581 and 1541 required to defer or threaten this bullish count, and in lieu of such, further and possibly accelerated gains should not surprise. Moving to the silver market on an intraday basis, you can also see the perpetuation of this month's recovery to new highs above last week's 40.88 high that has defined recent corrective lows at 38.86, absolute tightest, and 38.21.5 as the levels this market now is required to fail below to defer or threaten this bullish count. We think this latest spate of strength is important given the market's proximity to the recent resistance around the 50% retracement of May's sell-off attempt from 48.60 down to 33.49. 50% retracement on a daily log close-only basis cuts across at 40.34, and that's the level that capped the market last week. By virtue of the end of last week's and overnight's strength, the market has reinstated at least this month's uptrend, and now exposing further and possibly accelerated gains ahead, and quite possibly a run at that April 29th high at 48.60. Looking here at a daily log scale bar chart, you can see the developing potential for a bearish divergence in momentum. So it's absolutely critical that this market sustain these recent gains over the past few days above at least 38.86 and preferably the 38.21.5 corrective low from last week on an active continuation chart basis. That's the level this market now is required to fail below to confirm a bearish divergence in momentum that might expose a larger degree relapse or even reversal of the July gains. In lieu of such weakness, further and possibly accelerated gains are expected, and a bullish policy remains advised per such. I'd also like to return to this 4-hourly chart. We had to make a correction here. The risk parameter from last Wednesday's low is 38.21.5. That's the level this market should be required to fail below to confirm that bearish divergence in daily momentum, that would expose a much larger degree setback or risk or threat to the July rally. Finally, looking at a daily log scale chart of the copper market, you can see the market's current position at the extreme upper recesses of this year's range between 465 and 385, with the developing potential for a bearish divergence in momentum, a divergence that will be confirmed on a failure below the 431.45 corrective flow from July 12th. That will indeed break the uptrend from the early May low at 385 and expose a larger degree, if intra-range, setback of indeterminate scope. From a shorter term perspective, looking at a 4-hourly chart here, you can see the market's support thus far above last Thursday's 436.5 low. We believe that's the level, the tightest level this market needs to fail below to expose the short to intermediate term trend is down and put that 431.45 low from July 12th in jeopardy, while the market remains above at least 436.50. And preferably 431.45. The broader bull trend remains intact, and we anticipate eventually a break above that February 15th high at 465 on the premise that the entire sell-off from that 465 high down to the early May low at 385 is just a three-wave and thus corrective sequence that against the secular backdrop, secular bull trend backdrop shown in the log scale weekly chart here, I think ultimately is corrective and should exposes the resumption of that secular bull trend and new highs above 465. While that upper recesses of this year's range remain intact as a resistant candidate, however, and especially at the upper recesses of this range, we need to be particularly watchful for any kind of momentum failure that would expose another intra-range dip ahead of a resumption of the secular bull trend. And again, we feel that the most key level in that regard, in that momentum failure regard, is that 431.45 corrective low from July 12th. These issues considered, a bullish policy and exposure remain advised, although given waning upside momentum and the market's position at the extreme upper recesses of this year's range, we think that exposure should be paired to a more conservative risk amount, with a break below last Thursday's 436.50 enough to warrant shorter-term traders with tighter risk profiles moving to a neutral sideline position. But from a longer-term perspective, we still believe the market needs to fail below the 431.45 low from July 12th to warrant neutralizing all bullish exposure in order to circumvent the depths unknown of a correction, an intra-range or a correction within this year's broader range that we think at that point would at least test the 415 to 420 area, quite possibly the lower recesses of this year's range. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.